whenever you have a perceived risk, you should then kind of compare that to the actual risk, and before you make your decisions, because generally we're pretty poor at perceiving actual risk.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
Welcome to the Two Traders Podcast. It's Walter here. Hello, Darren. How are you?
I'm very good, Walter. Just relaxing.
Yes, you are. And I'm jealous. It's kind of cold where I'm at, and I know it's really nice and tropical where you are. So let's talk about this, Darren. We were thinking about risk just before we turned on the recording here, and talking about risk and how sometimes we don't really rationally assess the situation. And I was talking about the idea that a lot of surfers, a lot of surfing friends I have, they'll start talking about shark attacks, particularly when there are a few sharks sighted or shark attacks in a certain area. They'll say, oh, that area is sharky, I don't want to surf there, or it's quite sharky right now, I don't think and these sorts of thoughts pop into your head, which is not really that rational, because looking at the true odds, if you're waiting to cross the street and go to the beach and go and jump in the water, the odds are that you'll probably more likely die crossing the street, crosswalk or no crosswalk, than for you to have any sort of encounter with a shark or anything like that. So I find it fascinating how we and we all succumb to this, but we all have this problem assessing risk, and I just would like to get your thoughts on this.
Yeah, I mean, we are completely irrational about it, and the strange thing is we're all fully aware of what is you're talking about crossing the street. We're all aware that you're much more likely to die in a car than you are on a plane, but the fear of travelling by plane is much more prevalent than travelling in the car. And we got this information, but we seem to discount it. And I think that goes on a lot with trading, and what people perceive as being risky, if you looked at the facts, isn't. And one key, one obvious example is having a wider stop. It's instantly presumed that the more pips you're risking on a trade, the more risky it is, and you're basically discounting the win rate in that assumption, because at the same time we know that if you put your stop further away from price, it's less likely to be hit. So there's a balancing effect with the win rate, but we seem to discount that. And this is obviously it's a cognitive bias, because we all suffer from it. But if you don't address it, then you're not really assessing risk when you're trading, and I think that's a problem a lot of traders have.
Yeah, so thinking about this then, what's the bottom line? So if I, as a trader, unable to really assess the true risk, this means a couple of things, right? I mean, a couple of things spring to mind. It means that I'm probably not going to be very good at figuring out the likelihood of certain scenarios, because I overestimate some and underestimate others.
Yep, and I think that there's a problem with position sizing as well, because when I decide on my position sizing, I decide it on the losses that I've actually taken. So I look at my losses and base my position size on that, and I don't see a lot of traders doing that.
Right. So okay. So let's say you look back and you say, well, over the last 2 years, my average loser has been, let's say, for example, 150 pips. Is that how you look at it, or do you don't look at it in dollars? You look at it in pips, right? So you say my average loss is 150 pips, or something like that?
Yeah, I mean, you can look at it in monetary value as well. And, you can, if you're more cautious, you could look at your worst loss over a period. So, say your worst loss in your last year of trading was $1,000, say, then you can set your position size. So if you repeat that worst loss, then that's the most you're going to lose. So I think that's a more realistic way of working out your position size. I'm not saying it's the only way that will work, but for me, that's more logical.
Right, but doesn't it mean then if you have a loss, if the next trade you take is a loss, does that necessarily mean that it should be equal to the largest loss you've had in X amount of time, or it's just that that's the ultimate sort of line in the sand that you draw? Do you see what I mean?
No, I'm just what I'm saying is this was the worst my system performed in the last year. So I'm presuming it's unlikely that that's going to happen again. But if it does, then I know this is the most that I'm going to lose. And then I can decide, well, what is the most I'm comfortable with losing, and set my position size accordingly. Now, the advantage of that is, in theory, your worst loss should be, much greater than your average loss. So if you have an average losing week, it'll be less than the most you're prepared to lose in that week. So you're kind of erring on the side of caution that way.
Absolutely, yeah. But the other side of that is that depending on the amount of the volume of trades, the number of attempts, the number of trades you've taken, that you may underestimate your worst loss. In other words, you might have a future loss that's going to be greater than that largest loss, obviously, right?
Yes, that's entirely possible. But all you can really work on, if you're going to work on data, is the facts that you have to hand. So ideally, you'd have a longer trading history to look at how your system really performs in the long run. And obviously, unexpected things can happen, and you could have a much worse week. But in general, really, your trading should show some sort of consistency, and it shouldn't be wildly all over the shop. And if it's not really sort of consistent over a long period of time, then you're probably making mistakes in other areas, or it might just be that you've got your money management wrong in other areas. But generally, what I see in my trading history is fairly consistent results, whether they be losing weeks or profitable weeks. And possibly, depending on how you trade, that might be different. For instance, your style of trading, where you're waiting for specific setups, you might not have many trades in that week, like you say, whereas my strategy generally generates the same amount of trades each week.
Yeah.
Roughly.
Yeah, definitely, yeah.
But the important point is that when I'm looking at the risk, I'm, rather than a perceived risk, I'm saying, well, what's happened so far, that is actual facts of me trading the system, and I'm better to base my risk assessment on that than some assumption of what's going to happen.
Yeah, this is fascinating. I am a big fan of taking the data that you pull out of the Forex tester and doing, or whatever simulator you want, because you can get a lot more data than, especially if I'm a new trader, what do I do? So I can go into Forex tester and I can pound out 1,000 trades, and I can kind of look at that and eyeball it and go, well, my worst loss looks like this. Maybe I could double that and just kind of say, well, maybe I'll have one twice as bad as that at 200% of what that is. And I could kind of work off of that if I wanted to be really conservative. And the same thing with drawdowns and things like that. But would you recommend doing that? I mean, is that something that you, or you would just say, no, stick to only the real data that you have?
No, I would say that's definitely stage one. But then as you go forward and you're actually trading the system live, then you should be continually reassessing that and re-looking, taking another look at your risk. Because, when have we ever repeated the same performance live as we do in backtesting? Because, really then we're saying that there's not going to be any human error. There's not going to be any different emotions involved. And I think we can all agree that when you actually trade a system, what you're trying to do is get as close to your backtest performance as you can. But we all know that that's slightly unrealistic, and because there's a lot of other factors involved when you're trading live.
Absolutely, yeah, absolutely. And what about gaps? So what if somebody's trading a system where they hold the position over the weekend, which I'm guessing in most cases you wouldn't do the way that you trade. Is that right?
Sometimes not. It depends on the time.
Yeah. Okay. Right. Okay. So fair enough. So because that's the big one that people come up with, and it's so some people. And I find this really, to me, it's kind of backwards, but I'd be interested in your take. People will come up to me and they'll say, hey, I don't really like holding daily chart trades or whatever, 4 hour, 8 hour, whatever the weekly or whatever, because, I've got to hold it over the weekend and the market may gap on me when the market opens up again on Sunday, Monday, depending on where you're at, it's Sunday or Monday. And so I think that's really crazy because the flip side of that is, okay, so maybe I should be trading the 5-minute chart so I can be in and out and close my computer down and be flat at the end of the day every single day. But but the funny thing about that to me is if I'm in a 5-minute chart trade and some crazy news comes out, somebody wins an election that was unexpected to win, or someone's assassinated, or the Swiss National Bank decides they're not going to try and weaken the franc anymore, or what, tsunami hits Japan, pick your poison, right? Something like that comes out, and then the market really moves, surprise interest rate decision or whatever, I can get slipped massively on my stop on my 5-minute chart trade by magnitudes of 10. I might have a 10 pip stop, and I could get slipped and lose 22 pips on that trade instead of 10 or something like that. So to me, the reason why I think that's crazy is because if I have a weekly chart trade where my stop loss is 475 pips away, and I go into the weekend where the stop loss is, let's say I'm in a drawdown and I'm only 300 pips away from my stop loss, the chances of the market gapping 300 pips are and even if it does, I'm still just going to get out at about what I had risked anyway. You know what I mean? So to me, the idea that you can reduce your risk by getting in and out of the market and being flat every day is a little bit crazy, because you're in the market with essentially, in those trades that you're in, you have a lot riding on those. And if the market moves really quickly, you may not get hit at your stop. The spread may widen. All kinds of crazy things can happen. So to me, it's a little bit weird that people think that way.
Maybe it's more a feeling of lack of control because, your position's in the market and you can't really, you can't manage that trade. Really, the only issue with it is if your broker doesn't honour your stops, if it gaps past your stop. That's the only thing really to be afraid of, because essentially you're just holding a trade for 2 days, and if you're trading the higher time frames, then that wouldn't be particularly unusual anyway. So I guess that would be the only fear, and I'm not sure if my broker does honour stops if they gap, because it's not something that's really come up with me. But again, I think people are irrational about fear, and once that kind of fear is out there and it's talked about, it kind of becomes like a justified fear as well. So you see it commonly on forums, and then the rumor becomes truth because it's just been repeated so many times. And I see it with concerns about brokers as well. I've traded for 10 years. I think there's been one incident where I've had sort of reasonably large slippage, and other than that, my broker's been fine. I've had no issues with them, and I can take my money out when I want to. And I'm not saying be flippant about picking brokers, but again, it's like it's a risk and a fear that seems to be overinflated by people just talking about it.
Yeah, and what it is it comes down to, I believe, what it comes down to is the availability heuristic, which is this idea that when something you've heard about it, so and so was slipped at that broker, so I'm not gonna go and put my money with that broker, or somebody I know had an account here and then that broker shut down and he lost all of his money. Those sorts of things, those kind of stories float around and people freak out. It's hard, I think, today to find a broker. There are a few that will guarantee stops, but most of them, I believe, will tell you that they can't guarantee the stop. And there are a few. Some of them I think you have to pay more
Yeah, I think you pay a wider spread,
Yeah.
don't you, to have a guaranteed stop. And I did see somewhere someone did some sort of intense testing of it, and they found out by the time you added up all the extra you paid, you're actually worse off than than just going with a regular broker contract.
Yeah, exactly. It's like, well, it's insurance, isn't it? I mean, in the end, you're probably better off in most cases not buying the insurance, and then whenever the issue comes up, you have to pay, right? Whatever kind of insurance it is, but people feel safe if they have the insurance. So yeah, yep, it's exactly the same. This is something that's interesting to me, and I wonder what you think about this. There are some studies about this idea that when you're thinking about the likelihood of an event, if there's some information, some recent information, then you use that. So that's the availability heuristic, right? That's what they call it in psychology. Basically, it just means, so for example, if you're deciding whether to buy a stock, you just base your information on what you've heard recently about that company. You don't care about anything else. So you just think, well, it sounds like Apple's doing really well, and they had sold a lot of iPhone 27s, so I'm going to buy Apple stock or whatever it is. And the same thing happens when people who remember I don't know if they have these in the UK, Darren, but in the United States, they have these advertisements for drugs. So you can be sitting watching TV, and you're watching Seinfeld or whatever, Friends or whatever, and or some TV show. I don't watch a lot of TV. I don't know what Modern Family or something like that. And then these ads will come up for like antidepressants. And so you're supposed to go to your doctor and tell your doctor, yeah, I really want this antidepressant. But they've done studies where people who can remember seeing antidepressant advertising, they are more likely to overestimate the prevalence of depression. So people who don't remember seeing antidepressant medication ads on TV or magazines or whatever, they won't necessarily overestimate the number of people who are walking around depressed. And I find that fascinating that this kind of thing operates where so in other words, what I'm saying, Darren, is that depending on your point of view and the information that you're aware of, that's going to determine how you make your decisions based on risk, right? So what does that mean for the trader, right? I guess that's my question. What does this mean for the trader?
Yeah, I mean, this is why I like to sort of look at the worst case scenario, because one, it hasn't happened very often. Okay, so there's a low occurrence rate. Two, you decide what is the most you want to lose. Okay, so then if the worst case scenario happens, you've kind of maxed out your risk already. And I think too many people look at, okay, this is my average winning week, how much do I want to make? And they're just kind of looking at the best outcome. And then obviously when you have periods of drawdown or a particularly bad week, it hits you psychologically and financially, hits you much more severely. So, that's just kind of the way I look at it. And, the same when it comes to the actual position size of your entry. If I have a wider stop, I still continue using the same position size, because in my mind there's less chance, the real risk is of being stopped out on that wider stop. And if there's less chance of that occurring than a tight stop, then that balances out the fact that I'm actually risking more money on the stop out. And to me, that's logical. Why would you risk exactly the same position size on something which is less likely to be stopped out? It's like you're discounting one of the most important parts of the equation. And to me, that doesn't make sense. And I know that way of always risking the same percentage of your account does work. But in my mind, I can't get comfortable with that notion, because I'm thinking about the differing win rates.
Right. Yeah, totally. But Okay, so what you're saying is basically the disadvantage of risking the same amount per trade, because the stop placement is different in, let's say, pips, right?
Yeah.
So the dollar amount at risk is the same, but the pip placement is different. So that means it may be, 180 pips away from the entry price, or maybe 50 pips away from the entry price.
Yeah.
And those two trades theoretically would have different win rates, even if it's essentially the same reason why you're getting in. It doesn't really matter. The fact is that you're only 50 pips away from your current price, your entry price, and the other one you're 180 pips away, so over 3 times further away.
Yeah.
So you're saying that's got a higher win rate, right? But the advantage, of course, the traders listening to this are going to say yes, but the advantage is yes, it's got a very small likelihood that if I have this stop really far away, it's going to get hit. But when it does, it strikes the account like it's a real body blow to the account, right? I mean, that's a big chunk that if you're risking a lot, I mean, if you're risking more relatively because you say, well, it's unlikely to hit, then when it does, that's a real, it takes a real bite out of the account, I guess, right?
Well, yeah, but again, I think you're being irrational about the fear, because you should have first set your position size based on a long period of trading history and looking at groups of trades to set your position size. And if you just focus in on an individual trade, it will appear significant. But if I'm looking at my performance over 1,000 trades and setting my risk based on that, that one loss shouldn't be significant.
Right. Yeah, that's right. It shouldn't. And it would only be significant, of course, if it piles up and you get, they all sort of happen in sequentially, right? That's when traders start to change. That's when they change the game. Yeah. Yeah,
and that's kind of like perfect storm. And, the thing is, you can't avoid that just by adjusting your strategy and your risk, because sooner or later there's going to be particularly, an extended period of particularly bad market movements for your strategy, and throw in a bit of bad luck and trader error as well, you're going to have a really bad period at some point in your trading history. But the way I look at it, I've set my position size probably on the weeks that happened, because I'm looking at okay, what was the absolute worst week, and it'll generally be probably twice as bad as my average losing week. So I feel like I'm kind of setting my position size on those really horrendous weeks where nothing worked. For me, that's sensible.
Okay, yep, fair enough. Here's what I think traders should focus in on, and I'm not saying this is the only way to do it, but I think this is smart. You are essentially the one in control here with your position sizing and your risk management, because you can say, look, looks like I've got about a 65% win rate with this system. So based on that, I can look and see what are the chances, what's the likelihood that I'm going to have 7 losers in a row. Okay, so this all comes down to probability theory. Okay, and if you want to throw out probability theory and say it's useless or whatever, that's fine, but it seems to work pretty well for the casinos. But you know what I mean? So what I'm saying is, instead of people freaking out and going, "Oh my God, I've had a 35% drawdown. What's going on with the market? The markets have changed. The system doesn't work. I got to find something else. This is crazy. What am I going to do? I lost my life savings or whatever." What you really should be doing is, when you get into the game in the beginning, you say, okay, now what is it what I want to avoid? I want to avoid a 20% drawdown. That's the goal. Okay, so what's my win rate? All right, I've got that. So now what's the likelihood of X number of losing trades in a row based on that win rate? Okay, now you can work backwards from there, and you can decide what you want to risk. And that will help you avoid that 20%. It doesn't mean that you're not going to have it, because of course you might. But you can reduce the odds if you approach it that way. So poke holes in that theory. So what's wrong with that? Because I'm sure you have an interesting take on that. Yeah,
I don't think there's anything wrong with that at all. And I think that's kind of being rational about risk. So basically, what we're saying here, there's more than one way to be rational about risk in trading, but at the same time, as humans, we are naturally, because of biases, pretty irrational about risk. So, be aware of that, and perhaps, consider the sort of small ways where we sometimes perceive certain elements to be very risky, and just kind of use the same sort of rational process to go through that, and see if you are kind of being irrational. Because I think people they instantly jump to conclusions, like you say, when they get, let's say you normally trade the NFP with your strategy, and you traded the last one and it worked out particularly badly. Then on the next one, you're naturally going to think that trading the NFP all the time is a bad idea. But at the same time, you may have done, say, 2 years of backtesting, paid no attention to the NFP at all, and had a positive expectancy. And so there are more than a single way to sort of rationally plan risk in trading, but be aware that there's going to be a lot of occasions where you completely overestimate the risk and make assumptions.
When you say overestimate the risk, is that you overestimate the likelihood of something bad happening, or what do you mean? Yes,
like you were saying, because the last time it occurred, the outcome was bad, you'll instantly assume that that is a consistent, and it should always. It will always be bad. And the natural assumption, even though you may well have data that you know about that says it's actually okay to trade through the NFP.
Yeah, exactly. Yeah, and they've done studies with people where they say someone if someone can remember buying something really cheap at a store, then if they can easily remember buying, like the Harry Potter book Harry Potter 7 came out, and I remember buying it and it was only $19 over at that store, then what they'll say is everything is cheap at that store. You know what I mean? So it's kind of like you kind of paint everything with one brush, and it's the same thing with our trading. And I think that's it's not only risk that's part of this problem for us, because like you said, we had this really poor trade and we lost a lot of money, and you think that that's going to be what's going to happen in the future. But we do this with our trading too, where you go, well, wow, that trade just barely missed the profit target, and then it came back and ended up a loser. So next time that happens, I'll just pull the plug on the trade, even though it doesn't hit my profit target. Those sorts of things where you're trading the last trade. And I think people get into trouble when they do that. I think it doesn't have to be necessarily just risk. I mean, this sort of judgment error comes into play in a lot of different aspects of trading and in life in general.
Yeah, and I think you kind of have to, with anything you consider about your trading, there's like the perceived risk and the actual risk, and both succumb to variances over time, but you should really be making, whenever you have a perceived risk, you should then kind of compare that to the actual risk, and before you make your decisions, because generally we're pretty poor at perceiving actual risk.
Yep, absolutely, and it usually boils down to what is the what comes to mind, because if it comes to mind, then it's more likely, and if it doesn't come to mind, then maybe it's not so likely. So I can't remember the last time I was concerned about a tornado, but I haven't lived anywhere where tornadoes are very they're not big news. They just don't happen that often. Whereas some people are concerned about, if you live in South Africa, maybe you're concerned about getting carjacked every single time you get into a car, because it's something that happens. It's something that's known. It's in the news. People know about it. They trick out their cars with flamethrowers at the bottom, down underneath the car and stuff like that. Like they've got these did you know that? They've got these Batman cars, where they've got knives and flamethrowers. Yeah, they do. That's actually like a real thing. Like, it's crazy. But, but that's something that's top of mind in that sort of place. And in other places it's not, because it's really, to me, it boils down to, anticipating the worst with your trading and planning around that so that you try and avoid that. So it's kind of like exactly what you're doing. It's just kind of in a different way. And being aware of the fact that just because it's top of mind doesn't mean it's more likely. That's kind of my sort of main message, I guess, for this episode.
Yeah. I mean, you could also argue that, the way I decide my risk, it might well be just because I'm lazy and I don't want to have to work out, the correct position size for each trade all the time. I tend to try and reduce the decisions I have to make when I trade as much as possible. So that might be why I've decided to sort of work out my risk that way.
And do you ever think, like for example, when you have a bad loser, do you ever think, you never second guess yourself?
No, and I do find myself sometimes, thinking, maybe should just only take the trades where they're small bars. And, you get that kind of impression. It only takes 5 minutes to go back through the charts to realise that it's just a wrong assumption, and it's fear, and you're overestimating the risk. And, the most obvious one is big bars. Just compare large pin bars performance to small pin bar performance. You'll see that there's a distinct difference in the win rate, but we'll instantly perceive that the large pin bar carries more risk. I think the problem with that is also how some people decide on their exits. I mean, if you're going for a multiple R based on your risk, if you have a very large bar, then price has to travel much further to get, say you trade a set 3R risk to reward. If you have a 20 pip pin bar, then a 60 pip movement seems much seems more achievable, whereas the way I trade, 60 pip win on either of the size stop would equal the same amount of profit. So it's just a different way of moving the pieces around.
I've really enjoyed the discussion, Darren, and I hope that the listeners have as well. And I really appreciate it. Look forward to speaking with you next time.
Okay, thanks, Walter. See you soon.